The world economy today is facing some of the toughest headwinds we've seen since World War II. Now, depending on how you look at it, that could spell bad news or potentially even some good news. We're at a major crossroads, perhaps one of the most pivotal moments in modern economic history. I'm here to explain why things might not be as clear-cut as they seem, and why most people's perception of what's happening right now could be entirely wrong. To help understand where we are, let's take a brief trip through history, looking at key moments when the world faced similar economic challenges. This isn't just a boring walk down memory lane. History teaches us invaluable lessons, and it turns out that what we've seen before can help us make sense of what's happening today. Let's start with World War II. It was an incredibly significant time because, much like during the COVID-19 pandemic, large parts of the world had ground to a halt. After the war ended, everyone came back from the battlefields, and for a time, it was as if life resumed all at once. But there was a massive problem. There wasn't enough supply of goods and commodities to meet the sudden surge in demand. Global supply chains were shattered, and everyone wanted to start consuming again. The result? Inflation skyrocketed, with some estimates placing it at a staggering 133%. This period saw interest rates rise quickly, just as they are now. The result? The economy crashed right back into recession. The problem was simple. The prices of goods were rising, but people's wages weren't. Consumers couldn't afford the basics, and demand quickly fell off a cliff. This scenario is eerily similar to what we're seeing today. Back then, inflation was eventually brought under control, but not without serious damage being done first. The next relevant moment is 1974. You'll often hear people say we're reliving the 1970s, pointing to inflation as the common thread. While the inflation spike in the late 70s was significant, driven by the baby boomer generation entering the workforce en masse and the oil crisis, it wasn't exactly like what we're seeing now. A better comparison would be 1974 itself, when the Arab oil embargo caused oil prices to triple overnight. What happened next was predictable. Inflation soared, interest rates went up, and the economy tanked. In just 4 months, the stock market fell by 50%. Business confidence, measured by indicators like the ISM, Institute for Supply Management survey, plummeted to its lowest levels in history, falling to 30 when anything below 50 signals serious trouble. This rapid collapse was driven by a combination of supply shocks and monetary tightening, a recipe we're starting to see again today. The lesson from 1974 is this: inflation doesn't last forever. After that brief inflationary burst, the economy reset itself and inflation fell. In fact, this pattern, where inflation spikes and then recedes following a significant tightening of monetary policy, has played out multiple times across history. Fast forward to 1984, a time marked by a strong dollar, rising interest rates, and high inflation. The fear at the time was that the economy would repeat the painful experiences of the late 70s and early 80s. To prevent this, Federal Reserve Chairman Paul Volcker raised interest rates aggressively to combat inflation, pushing the economy to the brink. The dollar's strength became a problem, and it took the Plaza Accord in 1985, an agreement between the world's largest economies to stabilize the situation. A similar moment happened in 2008, when oil prices shot up to $147 a barrel and inflation was at 6%. The Federal Reserve was forced to cut interest rates to avoid a collapse, but the economy had already started to unravel due to a housing crisis. Just like in 1974, tightening monetary conditions led to an economic downturn. So, why does this same pattern of inflation, interest rate hikes, and recession keep happening? The answer lies in the way monetary policy impacts everyday people. When interest rates rise, the cost of borrowing becomes more expensive. For the average person, that means higher mortgage rates and more expensive loans, but their wages don't increase to match the rising cost of living. Right now, we're experiencing one of the fastest increases in mortgage rates in history, and it's hurting. People are spending more on their housing but have less money for everything else, which is why consumer demand is falling. This leads to lower spending across the board, from groceries to big-ticket items like cars and homes. Companies, in turn, are feeling the pinch, which is why we're seeing major firms like Amazon and big tech companies laying off employees. Everyone is tightening their belts. The big question on everyone's mind is, how bad is this going to get? We've seen recessions before, and technically speaking, a recession is 2 consecutive quarters of negative growth. But to most people, a recession feels like a loss of jobs and a decline in net worth. What's worrying is that we may be on the verge of not just a recession, but something much worse, a depression. Now, let's be clear. A depression is a prolonged period of economic hardship. I'm not saying this is a certainty, but the risks are high. One reason we might avoid a full-blown depression is because central banks, like the Federal Reserve, have a powerful tool at their disposal, their balance sheet. Essentially, the Fed can print more money, which can stave off the worst-case scenario, at least temporarily. Printing money has its dangers, though. It often leads to something much more insidious than inflation. It leads to the debasement of currency. When central banks print money, they lower the value of their own currency. That might sound abstract, but the effect is very real. It's why scarce assets like real estate, stocks, gold, and even cryptocurrencies tend to rise when currencies are devalued. These assets aren't necessarily becoming more valuable. They're just reflecting the fact that the dollar, or whatever currency you're using, is becoming less valuable. One of the new tools that came into play during the COVID-19 pandemic was direct transfer payments, essentially the government sending money straight to individuals. We saw this with the stimulus checks in the US, and similar policies are being implemented in places like Europe, Japan, and India. This concept, often associated with ideas like modern monetary theory, MMT, or universal basic income, UBI, is controversial, but it's likely to become a fixture in the economic landscape. While many see this as a form of economic lifeline, there's another side to it. Direct payments can exacerbate inflation and create more debt, making it harder to stabilize the economy in the long run. But in the short term, it's a powerful tool to keep the economy afloat. Another piece of the puzzle is the housing market, which is deeply interconnected with job security. If people start losing jobs, like we're already seeing with Amazon and other major companies, the impact on the housing market could be devastating. People can't pay their mortgages if they're unemployed, and that ripple effect could trigger a new housing crisis, similar to what we saw in 2008. What makes this moment even more precarious is the shift in the way we work. Office buildings are sitting empty as remote work continues to be the norm. Real estate investment trusts, REITs, which own these buildings, are starting to feel the pressure. Without workers returning to office spaces, the commercial real estate market faces a bleak future, which could further destabilize the broader economy. If we look back to history again, we can see how the debasement of currency has played out in different civilizations. The Chinese Empire was the first to experiment with paper money, and when they printed too much, their economy collapsed. The Roman Empire did something similar, debasing their silver currency by adding cheaper metals to their coins, which eventually led to the empire's downfall. Today, we're witnessing a similar phenomenon. The constant printing of money, combined with high levels of debt, is pushing us toward the same fate. The global economy is more interconnected than ever, and with most countries facing similar challenges, rising inflation, supply chain disruptions, and massive debts, the question is whether the current system can withstand the pressure. However, there's still a silver lining. If we look back to the 1940s, we see a period that began with immense economic challenges, but eventually led to a massive boom. After the initial shock, interest rates came down and the economy stabilized. Inflation ran slightly higher than normal, but that helped erode the value of war debt, and the post-war period saw huge gains in asset prices. The stock market surged by 900%, and real estate flourished. What's more, technological advancements and infrastructure rebuilding played a critical role in driving this growth. Factories were built, jobs were created, and the world rebuilt itself. This is the optimistic scenario, one where the economy doesn't just recover, but enters a new period of prosperity fueled by innovation, rebuilding, and smart monetary policy. This brings us to the present. The Federal Reserve has some magic left up its sleeve. If things get too bad, they can reverse course, stop tightening, and start cutting interest rates again. They could expand their balance sheet and inject more money into the system, just as they've done in previous crises. This may stabilize the economy, but but it also risks further devaluing the currency. The critical lesson from history is that economies are resilient. Even when things seem dire, there's often a path forward. But it requires careful navigation of the challenges at hand, balancing inflation with growth, managing debt, and avoiding the traps that have led to depressions in the past. Today's economic crossroads presents immense risks, but also unprecedented opportunities. History suggests that after periods of severe economic difficulty, we often see massive growth and innovation. The future, as always, remains uncertain, but understanding our past can help us prepare for what comes next.